This could cost you thousands, if not hundreds of thousands of pounds. Today, we're going to be talking about personal name versus company structure and which is the best thing for you. And this is all about tax efficiency and how to save tax when investing in property. So I promise I won't make it boring, and it's vital for you to understand. Like when you're building a house, you need to have done your proper calculations and plans to ensure that before you put the walls up, before you build the walls and the structure, your foundations are gonna keep that building up. You need to have done your calculations of what type of wall are you putting up? What are the other circumstances? Is it in a particularly windy area? All of that needs to be considered before, putting in those foundations and building the walls. And it's similar here. It's similar in property investing. You always need to start with the end in mind and start with your goals. So when it comes to the structure question, you do need to take into consideration your end goals, your current situation, whether your situation and circumstances are going to change, your salary is going to go up or go down, what age you are. All those things into the mix will help you decide which structure is best, because what you don't want to be doing is building those foundations, building those walls, and then realize you've made the calculations wrong and you need to bring all of it down, and it's going to be a costly exercise. And the equivalent is the same here, because you could potentially pay a huge amount of tax, which you don't have to if you get the structure right for you. So you need to have considered all those things in the round and speak to the advisors around you to ensure that you're making the right decision before you leap forward. So what do these terms mean? So looking at personal name, this simply means that the title of the property is registered to your name, or a combination of different names, whether your partner or other family members. And any income that you earn from that property, whether that be from rent or from the sale of the property, would then have to be declared as part of your taxable income through a self-assessment form that you'd send to HMRC at the end of the tax year. And this would be the same way as you'd declare any other earned income, either from salaries or from interest payments from your ISA. And your tax due at the end of the year would then be deducted from your, taking into consideration your income minus your allowable expenses. And in property terms, some examples of that could be management fees for the letting agent and boiler repair works, for example. And then you would be in a position to have your tax bill ready for you guys to pay, unfortunately. And the amount of tax due would be dependent on your tax bracket, whether you're in the 20% tax bracket or whether you're in the higher tax brackets of 40% tax and above. And what is a limited company? Well, a limited company is simply a company structure which any entrepreneur can use to start a business, whether that is a plumbing business, a coffee shop, a florist, or a large company. So for example, Lidl and Mars, just large privately held companies in a limited company structure. So this structure can be used to also hold property and manage property within. The company has to be set up in an official way with HMRC. It has to have a company name, a company number, a corresponding address, and it needs to have one director and one shareholder, and that's the kind of minimum you require. You can obviously have more than one director and more than one shareholder, and the shareholder and the director can actually be different people. So that's sort of the setup that you need to follow to open a company. And then there's ongoing maintenance and requirements that you need to do for HMRC. So this includes filing a set of annual accounts, so that's financial statements showing your income, your outgoings, your assets and liabilities, and all of that will normally be prepared by your accountant. Then you also need to provide an annual statement saying who is still the director of the company and who are the shareholders, and has there been any changes. So there's a few more hoops to jump through in terms of limited company and some of those formalities and requirements that HMRC has on an ongoing basis. But hold up, Jez, why are we even talking about this? Well, let me tell you, there was a time long, long ago, the golden age of property investing, as I've been told, between say 1995 and 2015. But then along comes the bad guy, guy. The bad guy is George Osborne. George Osborne comes along in 2015 and completely rips up the rule book and makes huge changes in terms of tax for property investors as a way of slowing down and changing the private rental sector, which they felt at the time had kind of got too big for its boots. He introduced much stricter and higher taxes for property investors. These rules were announced in April 2015, but didn't actually come fully into effect until April 2020. And what this has now meant is a lot of investors sort of thinking that the game's up and the game's over and that the rules have changed and the landscape has changed and it's kind of not worth their while anymore. And this has seen quite a few investors actually leaving the market, and it's actually caused the prevalence of limited companies as the way of investing in property. And if we look at the data, it really does show the impact of these changes on the property investing landscape. For example, we've seen a 491% increase in limited company use for property investing between 2011 and 2021. And on the flip side, looking at the reaction of landlords who already had property in their personal name, 33% of them said that their properties were no longer profitable, and 16% said they were considering selling because investing was no longer worthwhile. Just on a side note on that, we've obviously talked about this before in other videos, but we don't actually think that this is true, that it is no longer viable to invest. It's just that those landlords have failed to adapt to this new landscape and have been slow to kind of catch up, really. So that's why they're kind of really struggling. And what these changes meant was the fact that landlords could no longer claim back mortgage interest payments as part of their allowable expenses. So that was quite significant, given that the majority of landlords will be paying out a mortgage, but it will be interest only mortgages. And so all of that money, which is normally a fair chunk of their outgoings on a monthly basis, couldn't be claimed back as an allowable expense, so couldn't be tax deductible. And what that meant was that their net profits obviously reduced significantly, and for many, their returns plummeted. But hold on there. Don't just run off and go and start a limited company. Just want you to pause a minute, because it won't always be the case that a limited company is the right thing for you. Because as I mentioned earlier, there are so many different factors that need to be considered for your situation, including your age, your tax bracket, your salary, your personal circumstances, that you need to sit down with a specialist accountant or tax advisor to really get the best guidance for your personal circumstances. So let's look at some of these considerations in turn. So firstly, as always, it's looking at your goals. So this includes how many properties you want, what income level do you want from property, what exits are you going to have from your properties, are you going to hold them, are you going to flip them? All of those things need to be considered, because it will be a very different decision if you're looking to buy to let properties earning say £200 each per property, compared to buying a portfolio of 15 properties in Kent, which may, you know, have a gross rent or income of say £1,500 each per property. They're going to be very different decisions, and as I said earlier, you need to get the best decision for you at the time. The next consideration is your tax bracket, and there's two things within this that need to be considered, which is one, what is your current tax bracket? But then two, what tax bracket are you close to, potentially close to, that could be impacted if you started investing and therefore more money? The decision here will be very different depending on where you are on the spectrum of tax brackets, because a person who is at a 40% tax bracket but might be going into a 50% tax bracket is going to make a very different decision about their structure of investing compared to someone that's on minimum wage and might be earning sort of less than £15,000 a year, and then they're going to earn £10,000 a year, for example, on a buy to let. Then there's not going to be much of an impact on their tax position. So it really does depend on where you are on that spectrum, and all of those things need to be considered when making a decision here. The next consideration is how your income and circumstances will change over time, and this is where age comes in too, because someone who is 21, for example, and has the whole of their life ahead of them and their whole kind of career to earn as much income as possible, will be making a very different decision and have very different implications compared to someone who is 60 and nearing retirement age, because they're going to be in very different income tax situations. And for example, the person who is retiring, their income may go down because they might not have a great pension, so they might actually earn less than they did when they were are working, and they're going to make a different decision, and the tax implications of, you know, a few more buy-to-lets might not make as much difference as someone who is 21 and they're trying to future-proof any decision that they make and not hamstringing themselves by, you know, investing in a personal name, for example, and then realizing 20 years down the line that that's not the best circumstance for their tax position at that time. So it really does depend, and that's why we always say go and speak to an advisor, because there's so many different permutations here that all really need to be considered based on your personal circumstances. So as you can see, it's not really a case of limited company good, personal name bad. It really depends, like most things in investing, and I'm sorry to say, I know it's a boring and I sound like a broken record, but it really depends on you, your circumstances and your goals, and that's why we always say to go and speak to a specialist. There are a number of benefits of using an LTD structure that is worth just recapping. 19% corporation tax on rental profits, and this is compared to, in personal name, it would be 40%. A limited company also provides you flexibility in how to pay yourself. For example, you could pay yourself in dividends, in loan repayments. It's tax efficient because, unlike in a personal name, you can claim back mortgage interest, and this counts as an allowable expense. You can utilize intercompany loans or invoicing services between limited companies to allow profits from one to be invested in the other to provide even more tax efficiency. You can potentially save thousands of pounds on stamp duty. This is because under a limited company structure, you can buy shares in another limited company. So if you were buying a property company that owned a property, you can buy shares in that property company. Therefore, you pay no stamp duty if you are buying the company rather than buying the property. Lower capital gains tax if you sell your shares in your company. If you're exiting, if you're selling a property, you can save on capital gains tax that way. So that would be the reverse of what I was talking about earlier. So instead of buying a property company, you're selling your own property company and you're selling the shares rather than selling the property, and therefore your capital gains will be cheaper. And estate planning is the last one. It's more flexible for estate planning as well, and leaving properties to your children because they can become shareholders. So it just provides a lot more options and flexibility there compared to personal name. Let's look at benefits of investing in a personal name. Simplicity. There is far less hoops to jump through in terms of setting up and buying a property in a personal name, and it's much more easier to run it on an annual basis because there's less paperwork to complete. Cheaper borrowing. As mentioned, the borrowing tends to be 1 to 1.5% cheaper. You have more lending options under a personal name compared to limited company. Not too many, but it does make a bit of a difference. Cheaper accounting fees, because you could potentially do your self-assessment tax return yourself, and there is less paperwork to complete as well, which could also be a cost saving. So just to dispel a myth here around lending and limited companies, which is they still will be considering your circumstances as a director when making lending decisions around mortgages on the properties that you're going for. So whether you're a UK resident or an expat, what your salary is, how long have you been in your job, whether you're on probation, what your credit history looks like, and whether you own a property or not, as a residential or as a landlord, what is your loan to value of your whole portfolio if you have one. So all these things will be considered when making a lending decision for your limited company on that particular property. Because we've had, for example, our clients that have been turned down because they're expat or because they don't earn a certain amount of money through a limited company structure. So it can happen and needs to be kind of considered. If you want to talk to some experts on limited company formation for property investing and get some advice based on your circumstances and which is the right structure for you, speak to our friends at GetGround. The link is in the description to book a call in with them directly. So let's look at an example of an investor and their tax implications for both structures and what they should do. So we've got Catherine. She is 25. She's a lawyer and she earns currently 60K a year, which means that she is in the 40% tax bracket as things stand. But obviously, being a young lawyer, she is likely to earn more in the future. Her plan is that she's now looking to put her savings to use and purchase investment property for the future as a legacy for her children. She, at the moment, has got a high salary, low disposable income, and she doesn't have any children or dependents currently. She's aiming to buy property in the north every 2 years, and she's aiming for a portfolio of at least 10 properties by the time she is 40. She's targeting a monthly profit of 3K a month income. So let's do the numbers based on that scenario of her having 10 properties. So if we've got 10 buy-to-let properties at 600 gross per property per month, so that's the rental, that equals 72,000 gross income per annum. Now, just for ease, I am not including voids or management fees or maintenance. So that means that under her personal name, so we're doing personal name first, she's got a taxable income of £72,000. Now, we know that she is able to get back 20% tax relief on her interest payments. So that equals £8,000. So that's tax relief. That means her taxable income is £63,750. So that means in this scenario, she would pay tax of, at 40%, remember, £25,500 on her portfolio income once she had 10 properties. And if we look at the profit in her personal name, on the 72,000 income, she's got to pay a mortgage across all the properties at £41,000 per annum. She's having to pay £25,000 tax. So that means profit after all costs and tax, it's £5,250. So that is the money in her bank from 10 properties per annum. So let's look at how that compares is if she put it in a limited company, so LTD. So as we know, she's going to earn £72,000 per annum income from the properties. But a key difference here is that in working out her taxable income, you can take away the mortgage interest payments when working out your tax. So that means we can deduct £41,250, and remember that's interest only, which equals a pre-tax profit. So this is a taxable income of £30,750. So let's work out a tax from that. So remember, because this is a limited company, corporation tax is below 50,000 is 19%. So the tax would be 5,842 at 19% corp tax. Now, let's go back and look at the profit situation in comparison to personal name, because that's the most important thing we're looking at. What is the profit position from these properties? So looking at limited company, same income, 72,000. Same mortgage payments that she's having to make. But key difference here is that her tax position is very different. So she's only having to pay corp tax, which is 5,840, and that compares to the 25,000 over here. Her net profit is £24,980 after corporation tax. Now, obviously, that's quite a big difference to the 5,250 here. But let's be comprehensive here. Let's look at the dividends position as well. So, because obviously this is just tax from a company profit, but we need to understand her exact tax position. So, dividend tax for higher rate taxpayers is 33.75%, and there's some tax relief factored in. So based on a income of 24,000, she took that all out as dividends. She would have to pay £779,000 div tax. So we take the profit of 24, we minus this 7,000 tax for dividends, and that equals a net profit of £17,113. So we can see that on one side, we have personal name of £5,000 profit. On the limited company side, even factoring in corporation corporation tax and dividend tax shows a profit of £17,000 in comparison. So clearly, Catherine in her position should go to a limited company structure as she's making an additional 12k profit compared to personal name. Just to make a note on something that's rarely discussed when comparing these two different structures, which is paying yourself. And this is where we start to get a little bit more complex, because we're looking here about corporate tax and personal income tax. And we've already discussed that corporate tax for limited companies is at 19%, and the comparison is made between that and the 40% income tax. But it's not as straightforward as that, because if you actually wanted to pay yourself from your limited company, you could either pay yourself via a salary or you can pay yourself via dividends should you be making a profit. And then those dividends will be drawn down and paid as yourself as income. So then that would need to be declared income. So there you'll be liable for tax. Now there are different dividend tax brackets which are different to income tax brackets as well. So there is some savings to be made. If you do draw down dividends from your profits from your property company, you will be liable for tax on those. So you need to be aware about what dividend tax bracket you're in. Confusingly, there are different tax brackets for dividends compared to income tax with different rates. So it's good to be aware of what those are, but there is some savings to be made here. And for the higher rate tax bracket, it's 38.75. The next one is 33%, and then there's one at 18% as well. You do also get a dividends allowance where you don't pay any tax on the first £1,000 of dividends that you draw down. However, with limited companies, as I already mentioned earlier, there is a lot more flexibility on what you can do with them, and this applies to paying yourself as well. As I mentioned, you can pay salary, dividends, but there are other options. So another option you could do is to not actually pay yourself, so to keep the dividends in the business and then save the money there to then potentially buy another property in the future, and that means you'd only pay 19% corporation tax. Another example is if you lent the company money to buy the property itself in the first place, if the capital that you use is actually yours, then you could pay yourself back via a loan repayment, and that means no tax is due because that's essentially your loan that you're just paying yourself back. And another option is that you can potentially move money from one limited company to another if you had another limited company via an intercompany loan, and use that money elsewhere to potentially fund that business. And again, that's a tax efficient way of essentially paying yourself, but in a different way. So there is a lot more flexibility and things to play around with, but as ever, do speak to your accountant. So as you can see, there's a lot to consider and it's not a simple decision, and that's why I always say go and speak to a specialist, because there's so many things to consider and we don't want to make a wrong decision for you, and it really does depend on your personal circumstances, because this is a really crucial decision before you jump into property investing. You need to get it right. You need to ensure that your foundations are right. You do not want to put up those walls wrong and for your building to fall down, and that is the potential consequence for you for getting this wrong and paying thousands of unnecessary pounds in tax. So go and speak to a specialist, get your foundations right, get your calculations right, and then go out there and start investing. Thanks so much for watching this video all the way to the end. I hope you've enjoyed it. And if you have, can I ask a big favor? Could you please subscribe to the channel and hit this like button at the bottom of this video as well? It would really help us to grow and get this video out to more and more people like yourself. So thanks so much.